Former President Donald Trump made headlines by predicting 3% mortgage rates in 2025 or 2026. This prediction sparked hope for aspiring homeowners and fueled discussions about the future of the housing market. However, it's important to understand that the president doesn't directly control mortgage rates. Mortgage rates are influenced by a complex interplay of factors, with the Federal Reserve playing a pivotal role. While Trump's prediction might have been overly optimistic, it highlights the significant impact mortgage rates have on the lives of everyday Americans. At the heart of the mortgage rate equation lies the Federal Reserve, often referred to as the Fed. This powerful institution acts as the central bank of the United States, responsible for maintaining a stable economy. The Fed's role is multifaceted, encompassing various responsibilities that ensure the smooth functioning of the financial system. One of its primary objectives is to manage inflation and control unemployment rates. To achieve these goals, the Fed employs several monetary policy tools. One of its key tools is the federal funds rate. This rate dictates the interest banks charge each other for overnight loans, which in turn affects the interest rates consumers pay on various types of loans, including mortgages. By adjusting the federal funds rate, the Fed indirectly influences other interest rates, including those on mortgages. When the Fed lowers the federal funds rate, borrowing becomes cheaper, encouraging spending and investment. Conversely, when the Fed raises the rate, borrowing costs increase, which can slow down economic activity. This delicate balance is crucial for maintaining economic stability. The Fed's decisions on interest rates are not arbitrary. They carefully consider a multitude of economic indicators to strike a delicate balance. These indicators include employment data, inflation rates, and overall economic growth. By analyzing these factors, the Fed aims to create an environment that fosters sustainable economic growth. Their actions have far-reaching implications, affecting everything from the cost of borrowing to the health of the job market. Ultimately, the Fed's goal is to ensure a stable and prosperous economy for all. Their decisions impact not just financial markets, but the everyday lives of citizens, influencing how much we pay for loans, the value of our savings, and the overall economic climate. The connection between the federal funds rate and your mortgage rate might seem distant, but it's more direct than you might think. The federal funds rate is the interest rate at which banks lend to each other overnight. This rate is set by the Federal Reserve and serves as a benchmark for many other interest rates in the economy, including those for mortgages. When the Fed adjusts this rate, it sends ripples throughout the financial system. When the Fed raises the federal funds rate, banks face higher borrowing costs. This means that banks have to pay more to borrow money, and they often pass these costs on to consumers. As a result, the interest rates on various types of loans, including mortgages, tend to increase. Higher mortgage rates can make buying a home more expensive, as monthly payments rise. To maintain profitability, they pass these increased costs onto consumers through higher interest rates on loans, including mortgages. This can affect your ability to afford a home or refinance an existing mortgage. On the other hand, when the Fed lowers the federal funds rate, the opposite happens. Banks can borrow money more cheaply, and they may pass these savings onto consumers in the form of lower interest rates. Conversely, when the Fed lowers the federal funds rate, borrowing becomes cheaper for banks, potentially leading to lower mortgage rates. This can make home ownership more accessible and affordable for many people. Lower mortgage rates can also stimulate the housing market by encouraging more people to buy homes or refinance their existing mortgages. This ripple effect highlights the interconnected nature of the financial system and the significant role the Fed plays in shaping the mortgage landscape. Understanding this connection can help you make more informed decisions about buying a home or refinancing your mortgage. By keeping an eye on the federal funds rate and the Fed's actions, you can better anticipate changes in mortgage rates and plan accordingly. Imagine you're eyeing a $500,000 home. It's a beautiful property in a nice neighborhood, and you can already picture yourself living there. But before you get too excited, it's crucial to understand how mortgage rates can significantly affect your monthly payments and overall financial health. Let's break it down. With a 30-year fixed-rate mortgage at 7%, your monthly principal and interest payment would be around $3,327. This amount doesn't even include property taxes, homeowners insurance, or any other potential costs like private mortgage insurance if your down payment is less than 20%. Now, envision the same scenario with a 3% mortgage rate. This lower rate can make a world of difference. Your monthly payment plummets to about $2,108, saving you over $1,200 each month. This substantial reduction in your monthly obligation can ease financial stress and provide more flexibility in your budget. This stark contrast illustrates the profound impact even a small percentage change in mortgage rates can have on your financial well-being. A lower rate not only reduces your monthly payments, but also decreases the total interest paid over the life of the loan, potentially saving you tens of thousands of dollars. Lower rates translate to lower monthly payments, making homeownership more affordable and freeing up funds for other essential expenses or savings goals. This extra money can be used to pay off other debts, invest in home improvements, or even contribute to your retirement savings. Understanding the impact of mortgage rates is crucial for making informed financial decisions and achieving long-term financial stability. Section 5. Inflation's tug-of-war. A key factor in the Fed's decisions. Inflation, the rate at which prices for goods and services rise, is a constant concern for the Fed. When inflation runs rampant, the Fed may raise interest rates to cool down the economy and curb spending. Higher interest rates make borrowing more expensive, theoretically slowing down demand and stabilizing prices. Conversely, when inflation is low, the Fed may lower rates to stimulate economic growth. Finding the right balance is crucial for a healthy economy. Section 6. Government's helping hand, Fannie Mae, Freddie Mac, and the mortgage market. Beyond the Fed's actions, government policies also play a role in shaping the mortgage market. Government-sponsored enterprises like Fannie Mae and Freddie Mac are key players in the mortgage industry. They purchase mortgages from lenders, freeing up capital for lenders to originate more loans. This government involvement aims to ensure liquidity and stability in the mortgage market, making homeownership accessible to more Americans. Changes to these institutions' structures or government regulations could potentially impact mortgage availability and rates. Section 7. A delicate dance. How supply and demand shape the housing market. The housing market operates on the fundamental principles of supply and demand. When mortgage rates are low, borrowing becomes cheaper, increasing demand for homes. This increased demand, coupled with limited housing supply, often leads to higher home prices. Conversely, when mortgage rates rise, affordability decreases, potentially cooling down demand and slowing down price growth. The interplay between these forces determines the overall health and direction of the housing market. Section 8. The politics of housing elections and their potential impact. While the president doesn't directly set mortgage rates, their policies and appointments to the Fed can indirectly influence the housing market. The 2024 election could bring about policy changes that affect the housing market, such as tax incentives, regulations, or government spending on affordable housing programs. These political decisions can create ripples that influence mortgage rates and the broader housing landscape. Section 9. Looking ahead. Navigating the uncertain future of mortgage rates. Predicting mortgage rates with certainty is a fool's errand. The complex interplay of economic factors, government policies, global events, and even consumer sentiment makes forecasting an imprecise science. Rather than relying on predictions, focus on understanding the factors that influence mortgage rates. Stay informed about economic indicators, Fed announcements, and potential policy changes. By staying informed and working with knowledgeable professionals, you can make sound financial decisions that align with your individual circumstances and long-term goals.